Jack with the Trading Tribe. Excited to be back at it today with another lesson video, and we're really going to tag team what we talked about last time. We're going to kind of look at the other side to trading futures and how to actually short in the futures market. So if you haven't seen the other video, please check that out first. It'll kind of really make sense. We'll tie it all together here and kind of continue on our previous discussion. So also hit a like and subscribe to the channel for a lot more content like this. Tons of beginner to advanced type content coming in 2023. But if we look at the screen here, I'm actually using the same day, the same instrument as that last video to kind of keep it simple. And we'll talk about how to short in the futures market and like what that consists of, what the orders are like, and how we can actually do that in the markets. So if we look at today, for example, for natural gas, really the same concepts are just flipped. So just like we talked about on the buy side, you will need to know that position size. So how many futures contracts that you want to short in the given market that you're trying to trade. And once you know that, you can essentially start that short position. So a lot different than the stock market, right? You don't have short sellers restrictions. You don't have to find shares to short. If we want to bet against natural gas, for example, let's just say it's in a downtrend and we want to short into a pop, we can do that right away, right? There's no rules on it has to be an uptick to short. We don't have to worry about borrow fees. We don't have to worry about any of that on the short side, which is a huge win with futures in my opinion. There's a lot of rules if you're trying to short like small caps or pump and dumps, and it gets really complicated and expensive. Whereas on the futures side, there's no rules, right? If you want to short in the market, we'll kind of go over how to actually do that, but that's it, right? There's no complicated fees or rules associated. And if we open up Active Trader, this is just how I'm going to show it today. You can put in orders on your phone. You can put in orders manually. You can do it a bunch of different ways. This is just the best way to actually do it on Thinkorswim. And in this case, I'll open up the Active Trader pane and we'll notice very similar things as the last video, right? So here's where we're going to choose our contract size. So in this case, let's just pretend I want to short one contract of natural gas. I'd make sure there is a 1 selected here. And then the way the shorting works on the future side in terms of like the order sequence is very similar to the stock market or the Forex market, right? What you're essentially doing is you're selling before you even have it. So if you think about the buy side, we're buying it first, and then when we want to exit the position, we're selling it. The futures market is just flipping that on its head for shorting. So we're selling it first, and then ideally, right, to exit, we're buying it back lower, and that's how we make that difference or that profit margin. Obviously, right, if you short and it goes up, right, that's not ideal, and it can hit your buy side stop loss. We have videos on, OCO brackets and all of that on the channel. But essentially you're just selling the position first to take on the short position and then to actually exit the trade, regardless of if the trade works or not, is to essentially buy it back from the broker. So if we did want to short here, let's just pretend we want to short if it pops up to 2.45, for example. We can choose that contract size, we can choose that order type here, and then essentially on the price ladder, we can just go up to 2.45 in this case, right? And instead of buying it like we did on the long side, if we wanted to short a position in the market, we would make sure to go into the ask column, which is essentially all of the different prices that sellers are willing to sell at, and choose our price point. So here, we're willing to sell one contract or short the market at 2.45. So we could just drop in the order and close this tab, for example. And now we have a fantasy short order that would get filled, right, if price popped up to this level. The market's actually down right now. It's the weekend, so the market hasn't opened again. That's why the price is kind of stable and not moving here. But this is how we put in that initial short order. and then essentially to get out of the position, we would actually buy it back. So in this case, right, let's just pretend price comes up here and fills this order. We would be short one contract in the market. We would see a -1 here. So I wish they had a better way to kind of show you that you're short, but it'll essentially just say -1 to show you that you need to buy it back to exit essentially. And that second order, right, let's just pretend it drops down to 2.4 and we're up $500 and we're ready to exit. There's a couple ways we can do that, right? We can have a target order put in, or we can click buy market to actually just get us out and find the nearest buyer and seller and fill the position. Or we could put in another order on the ladder. So we could just say, you know, we want to sell it at 2.35, for example. And we could drop in that buy order, and that would essentially fill us if the price does flush down to that level. So hopefully this helps a lot. This is how to short in the market. There's not much complication here actually, so no additional fees, no additional locates that are needed, and this would be how to essentially take on a short position in the market. Thanks guys.